Should you form an LLC for your California business? For many new business owners trying a new idea, the answer is not necessarily yes. An LLC does not automatically lower your taxes. It does not protect you from every type of liability. And in California, it comes with an $800 annual cost in 2026 that continues until the LLC is properly cancelled. So should I form an LLC is the wrong question. The right question is, which business structure actually fits what I'm building? A sole proprietorship, LLC, S-corporation, and C-corporation can each make sense, but for very different businesses and at very different stages. The structure you decide impacts how much you pay in taxes, your personal liability, retirement plan options, your credibility with clients, bookkeeping and payroll requirements, and your ability to raise outside capital. In this video, I'll compare the 4 common structures: sole proprietorship, LLC, S-corp, and C-corporation. I'll explain why California makes the choice even more complicated. And I'll give you a practical framework for deciding which structure best fits your business. Hi, I'm Aaratee, founder of Aaratee Financial. I've spent more than 20 years at the intersection of finance and technology in Silicon Valley, including leadership positions at major technology companies and leading financial institutions. On this channel, I break down practical tax, investing, and wealth management topics for high-income Californians. Today's topic is for solopreneurs, self-employed business owners, founders, consultants, freelancers, W-2 employees with a side hustle, or anyone starting a new business in California. We will cover the 4 common business structures and where each one fits, the California fees that can change the decision, how an S-corp election actually works with a concrete example, what people often misunderstand about liability protection, retirement plans, reasonable compensation, bookkeeping, and payroll, and finally, a practical framework you can use before deciding on a structure. The goal is not to create the most complicated business entity possible. The goal is to use a structure that fits your income, risk, growth plans, and your tolerance for administrative work. Solo business owners in California generally consider 4 common paths. The first is a sole proprietorship. This is the default. It's inexpensive, simple, and easy to start. But there is no legal separation between you and the business. The second is a single member LLC. An LLC creates a separate legal entity that can help protect your personal assets from certain business liabilities. The third is a single member LLC that elects to be taxed as an S-corporation. This is not a different legal entity. It is a tax election, often considered by profitable service business owners. The owner pays themselves a reasonable W-2 salary and may take additional profit as distributions. The fourth is a C-corporation. For most solo service businesses, a C-corporation is usually not the most practical fit. But for venture-backed startups planning to raise outside capital, issue stock options, and potentially qualify for QSBS treatment, a Delaware C-corp is often the most standard structure. So the decision is not simply LLC or no LLC. The real questions to ask are, what are you actually building? How much profit do you expect? Do you plan to raise outside capital? And what risk are you trying to manage? Let's start with the simplest option, the sole proprietorship. If you start freelancing under your own name and have not formed a legal entity, you're generally operating as a sole proprietor by default. This is perfectly reasonable if you are testing a relatively low-risk business idea. For example, you may have a side business earning $25,000 a year with minimal liability exposure, no employees, no major contracts, and no plans to raise outside capital. In this situation, the simplicity may be worth it. You report your business income and expenses on your personal tax return, typically Schedule C. There is no separate California LLC filing fee, no separate legal entity, and no annual LLC tax. But the downside is important to understand. There is no legal separation between you and the business. So if something goes wrong, like a contract dispute, unpaid business debt, or a client lawsuit, then your personal assets may be exposed. So a sole proprietorship can be a reasonable starting point while you test a new business idea and see if it gains traction. But it may not be the best long-term structure as your business grows, takes on more risk, or enters into larger contracts. The single member LLC is a structure that most solo business owners, consultants, and freelancers ask about. LLC stands for Limited Liability Company. Its main value is legal separation. An LLC creates a business entity that is legally separate from you. This separation can help protect your personal assets from business debts, contractual obligations, and other business liabilities. This can become more valuable as your business grows, enters into larger contracts, hires employees or vendors, and faces higher legal and financial risk. But you do not need a LLC to operate under a separate business name. A sole proprietor can also create a DBA or doing business as and create a separate business brand. The difference is DBA is only a name. It does not create a separate legal entity and does not provide liability protection. But here's the key point. An LLC does not automatically reduce your taxes. By default, a single member LLC is treated as a disregarded entity for federal income tax purposes. That means your income and expenses still flow through to your personal income tax return on Schedule C, much like a sole proprietorship. You still pay income tax and the self-employment tax. The LLC changes the legal structure of the business. It does not necessarily change how the business is taxed. And in California, that legal structure comes with an additional cost, which I'll cover shortly. There is also annual LLC tax return in California. So the main reason to form an LLC is a legal structure and liability separation, not an automatic tax break. Whether you remain a sole proprietor or form an LLC, one of the biggest mistakes new business owners make is mixing personal and business finances. At first, it may seem harmless. You use your personal credit card to pay for software, you deposit client payments into your personal checking account, or you pay contractor using your personal Venmo account. But over time, this can create a mess. From a tax perspective, it becomes difficult to track and support your business income and deductions. If the IRS or California FTB questions an expense, clear bookkeeping can make a significant difference. And if you have an LLC, consistently mixing personal and business funds can weaken its liability protection by making the business look less separate from you. So the basic rule is open a separate business bank account, use a separate business credit card or another dedicated card for business expenses. Keep separate books, save your contracts, invoices, and receipts. A business entity does not protect you simply because you filed the paperwork. How you operate the business matters too. Now let's talk about S-corp election. An S-corporation is not a separate legal entity that you form in California. It's a tax status. Many solo business owners form an LLC first and then elect that LLC to be taxed as an S-corporation. A corporation can also elect S-corp status. This election reduces the amount of business profits subject to Medicare and Social Security taxes. Here's the basic idea. When your business is taxed as a sole proprietorship or a single member LLC, the net business profit is subject to self-employment taxes. With an S-corporation, the business pays the owner a reasonable W-2 salary. That salary is subject to payroll taxes. But after deducting the salary and other business expenses, the remaining pass-through profit is generally not subject to Social Security tax or Medicare taxes. It is still subject to income tax. For 2026, the Social Security tax has a wage limit, while there is no wage limit for Medicare taxes. So the potential savings depend on several factors. How much profit does the business earn? What is a reasonable salary for the services you offer? Do you earn W-2 wages from another job? And how much the additional payroll, tax preparation, and administrative work will cost? And here's an important warning. An S-corp election is not something you make casually. You need to run payroll. You need to establish and document reasonable compensation. You need to file separate federal and California business tax returns, and you have additional bookkeeping, payroll tax, and filing requirements. California also taxes S-corporation at 1.5% of California's net income, subject to a minimum of $800 in 2026. So an S-corp election could create tax savings, but the tax savings must be large enough to justify the additional taxes, professional fees, and the administrative complexity. Let's use a simple example. A single filer California consultant earns $250,000 in business profit in 2026 and pays themselves a reasonable S-corp salary of $150,000. As a sole proprietor, the federal self-employment tax and additional Medicare tax could be roughly around $29,900. With the S-corporation, payroll taxes on the $150K salary would be roughly around $22,950,000. The remaining profit would generally not be subject to self-employment tax. That creates roughly $6,900 of federal tax savings. But California's 1.5% S-corp tax, payroll services, additional tax returns, and bookkeeping costs may reduce the net benefit. So an S-corp may save taxes, but the savings are not simply 15.3% of every dollar distributed. The numbers need to justify the added complexity. Another issue is retirement planning. How your business is taxed can impact how much you can contribute to a solo 401k or a similar retirement plan. For sole proprietorship or a single member LLC taxed as a disregarded entity, the retirement contribution is generally based on the net self-employment income. For an S-corp owner, retirement contributions are based on W-2 compensation, not S-corp distributions. That means paying yourself a lower salary may reduce the employer retirement contribution capacity, even if it creates payroll tax savings. In other words, payroll tax savings may come at the cost of lower employer retirement contribution. This is why S-corp elections should not be evaluated only through the lens of self-employment tax. You should also consider retirement contributions, bookkeeping, payroll cost, employee benefits, California taxes, and your overall household tax picture. Now let's talk about C corporation. For most solo consultants, freelancers, and solo service business owners, a C corp is usually not the best fit. Why? Because a C corp can create double taxation. The corporation pays taxes on its income, and if the profits are distributed as dividends, the owner may pay tax again. This is usually not ideal for a solo business owner if the owner plans to take most of the income out of the company. But for a venture-backed startup, the analysis is different. A Delaware C corporation is often the standard if you plan to raise venture capital, issue stock options, or bring in more investors. It may also allow the founders and investors to qualify for the federal QSBS if all the requirements are met. So if you're building a venture-backed startup, a C corporation may be the right starting point. If you're building a solo consulting business, it is usually not. The California taxes could change your decision. This is for the year 2026. A sole proprietorship does not have separate entity level taxes. The profit flows to your personal return and is generally subject to income tax and the self-employment tax. The default single member LLC is also taxed similarly, but California also charges an additional LLC tax of $800. There's an additional LLC fee once your California income reaches $250,000. And you also have to file an LLC tax return in California. An LLC taxed as an S corporation pays California tax of 1.5% of net income. A C corporation pays California corporate tax of about 8.8%, and the owner may pay additional taxes on salary and dividends. Also, California does not provide the QSBS exclusion. Forming a business entity in Delaware or Wyoming does not eliminate California fees when the LLC is actually doing business in California. So if you're testing a low-risk idea with limited revenue, simplicity may win. But as the business grows, risk grows, contract grows, the cost of a formal structure may be well worth it. Let's look at how this plays in 4 real-world scenarios. First scenario, you have a side business earning around $25,000 a year with minimal liability and no employees. A sole proprietorship may be perfectly reasonable while you test the idea. Second scenario, you are an established consultant earning $180,000 with ongoing clients, contracts, and more business risk. A single member LLC may make sense for legal separation, and as profits grow, an S-corp election may be worth evaluating. Third scenario, you are building a software company and plan to raise venture capital. In that case, Delaware C Corporation may make sense from the beginning, especially if stock options, outside investors, and potential QSBS treatment are part of the plan. Fourth scenario, you have a full-time W-2 job and a profitable side business. Here, the answer depends on the level of profit, the liability risk, whether the business may eventually become your primary source of income, and whether the potential benefits justify the added cost and complexity. The key point is there's no single best structure for every business. The right structure is the one that fits the business that you are actually building. Here are 7 common mistakes to avoid. Forming an LLC without understanding California's $800 annual cost. Thinking an LLC automatically reduces your taxes. It does not. Electing S-corp status before potential tax savings justify the added complexity. Failing to pay and document reasonable W-2 compensation as an S-corp owner. Ignoring how the business structure and tax treatment may affect retirement plan contributions. mixing personal and business finances after forming an LLC, waiting until the business has already grown significantly before considering a C-corp structure and potential QSBS eligibility. Most of these mistakes happen because people select a structure before clearly defining the business they are building. So before forming a business entity or electing a tax status, slow down and ask yourself, what am I actually building? And that question leads to a simple decision framework. So before forming an entity or making a tax selection, ask yourself these 6 questions. What is my realistic profit this year and next year? What liability risk does the business create? How will California's taxes and fees affect the decision? Am I building a solo service business or a company that plans to raise outside capital? How will the structure and tax treatment affect my retirement plan contributions? Are the expected benefits worth the added cost and complexity? The goal is to use a structure that fits your business, risk, tax picture, and the long-term direction, and not the structure someone recommended online without understanding your business. If you found this helpful, please subscribe for more videos on tax-efficient investing, tax planning, and cash management for Californians. And if you want help to think through your own cash management, tax management, and portfolio management, you can learn more on our website, orifinancial.com. Thank you for watching, and I'll see you in the next video.